After the 1970s, financial speculation and asset bubbles began to undermine U.S. industrial growth due to a fundamental transformation in how the American economy operated. Until that point, economic strength was largely built on manufacturing, infrastructure, and industrial output. Factories were the backbone of employment and export growth, and investments were directed toward expanding physical production. But in the 1970s, several changes started shifting this model. First, the U.S. abandoned the gold standard in 1971, which led to more flexible currency policies and greater volatility in global markets. Then came a series of oil shocks and stagflation that disrupted industrial profitability and made traditional production less attractive to investors. At the same time, financial deregulation picked up pace, especially during the Reagan era, allowing banks and financial institutions to take on more risk and engage in speculative activities. These conditions fueled the growth of financial markets, where capital could chase short-term gains through stocks, bonds, derivatives, and other financial instruments rather than long-term industrial development. As corporations realized they could earn more by playing financial games, like stock buybacks, mergers, and speculative trading, than by building factories or hiring workers, the flow of investment capital shifted sharply toward finance. This process, often referred to as financialization, made the economy increasingly dependent on Wall Street rather than Main Street. The dot-com bubble in the 1990s and the housing bubble in the 2000s are clear examples of how speculative investment became dominant. These bubbles created artificial wealth that collapsed suddenly, causing widespread damage to the real economy. Meanwhile, industrial jobs continued to vanish, partly due to globalization and outsourcing, but also because fewer resources were being directed toward industrial innovation and capacity building. Instead of reinvesting profits into machinery, worker training, or R&D, many firms used earnings to inflate their share prices and please investors. Over time, this eroded the industrial base of the U.S. economy. Productivity gains became concentrated in the tech and finance sectors, leaving traditional manufacturing behind. As speculative profits surged, inequality grew, and long-term economic stability declined. The U.S. shifted from a producer-based economy to one where consumption, debt, and speculation played oversized roles. This imbalance made the economy more vulnerable to crises and less resilient in the face of global competition. So while financial speculation brought short-term gains for some, it came at the expense of sustained industrial growth and national economic strength. To learn more about how financial trends affect real-world markets and trading strategies, visit my Facebook page, Binary Options Strategy.